Well, let's get into that because the use of it.
Let's not bore people with fees forever.
No, well, I mean, it's good. I mean, I think people are going to need to know this. So, I mean, they're going to want to know why people would sell these products. And, I think first and foremost, we look at it as a method or a way to create a lifetime income stream for someone. Yep. Okay. That's the first thing why we would use an annuity.
That's the only reason I ever use annuities.
Yeah. I mean, it is something. And look, I've run into people that if I would have let them have, or let's just back up and like define what an annuity contract is. Okay. So there's typically 3 parties in an annuity contract. You have the issuer of the annuity, which of course would be the insurance company. Yep. You have the annuitant, which is the person that's actually going to get paid out the money. And then you have the beneficiary, which would be the person, if something happens to the annuitant and there's money left over, that goes to a beneficiary.
Yep.
Okay. The annuity contract basically states a number of things, but I think the basic of it is that the annuity, and depending on the type of annuity, we're going to talk about like fixed and fixed index annuities, not variable annuities, because those are securities. The insurance company is going to guarantee your principal, and Yep. they're going to give you the option to convert that amount into a lifetime income stream.
A guaranteed lifetime income stream.
A guaranteed lifetime income stream that would last the rest of your life.
Yep.
Okay. And then they generally will have a lot of other benefits, like you can take lifetime income withdrawals or how they classify. Yep. But that's the basic of an annuity right there. That's all it is. Yep. Contract between you and an insurance company. You give them a lump sum of money. They're going to tell you, hey, you can, money is going to be protected from any kind of loss as long as you don't do anything, stupid, like surrender it early. And you got to get a guaranteed lifetime income. That's it. Like, okay.
Yep. And the years in between that deposit and the start of lifetime income, your money is able to grow based on the performance of an outside stock market index, such as the S&P 500.
Yes. And then we'll get into, they typically don't perform as well and they don't have the same. And you know what? Oh, that's true to some degree.
Yeah, annuities aren't meant, if you go back to how they gain return, you get part of the upside and none of the downside.
Yeah.
All right. There's no such thing in the financial world as all of the ups and none of the downs. That would be too good to be true, right? So you get part of the ups. Now, annuities aren't meant to compete with the stock market. They're not. If I have a 20-year time horizon and I put 100,000 into each, I can't say I guarantee, but I can all but guarantee you the stock market account will be worth a good amount more 20 years from now. Most likely.
Probabilities are very high.
Very high.
It's going to be higher in value than that.
But we're not buying annuities for their accumulation benefits.
Nope.
We're buying them for their income benefits.
Yes.
Because that stock market account, I can pull 4 to 5% a year out of. And it'll probably last till I die. Statistically, it will, but
there's no guarantee.
There's no guarantee.
Right.
Whereas the annuity contract is going to pay me out 4 or 5%, maybe even 6%. And it is guaranteed for as long as I live. So really all an annuity is taking money and making it a private pension.
That's right. You are trying to do something to assure that you have a lifetime income so that you don't ever have to worry about running out of money. And you're basically using an insurance company to do what they do, which is insure things.
Yep.
It's not rocket science. That's what they do. And I don't see any reason why carving out a portion of someone's portfolio to put in some kind of a contract like this is not prudent.
No, if you want to look at it on a return perspective, like I said, it's not going to compete with stocks, but
Would it compete with bonds?
Pretty similar to bonds.
Yeah, I would say so. Except you don't necessarily have the interest rate risk, although I guess you could say that you do have that. If interest rates go up and down, it affects the index performance and the caps and such.
You don't have default risk is what you don't have.
Correct.